I will be discussing the methodology of difference in difference analysis, specifically applying it to the leverage case study. As we know from finance literature, when a company experiences a marginal tax benefit that is greater than the marginal default risk resulting from increasing its debt levels, then these firms will be encouraged to take on additional debt because doing so will provide an added tax advantage. This particular principle is based on what we call the static theory. So, if there are no restrictive covenants in place that would prevent them from taking on additional debt, then a higher corporate tax rate is likely to encourage companies to depend more heavily on debt financing, because this approach will provide a greater tax shield for their financial income statements. So, in order to verify the validity of this particular hypothesis, we will proceed, as is our standard practice, by utilizing the functionalities provided within the Finance SHGit repository. My intention is to select the annual frequency, specifically a singular one, due to the fact that both x and y variables possess an identical frequency. Therefore, we will apply this consistently across the entirety of the observation period. Now, the event period itself, which constitutes the fundamental core component of our event study analysis, will naturally fall within this predetermined range. Now, regarding the various x variables that might significantly influence the total amount of debt, we could certainly include factors like the return on assets and the overall size of the company. The asset's tangibility and the variable for potential growth opportunities was recorded at market value. And now let's take a moment to explain the rationale for our primary dependent variable, which we have identified as leverage. More specifically, what we are observing and measuring is the significant change in the long-term debt. The growth that we observe in our long-term debt, this specific metric will be designated as our y variable. So, as we scroll down, we first need to check for any outliers in our data, and then we also need to properly define and build our treated firm group. In an event study, there are two key elements we must clearly establish. First, the treated firms, these are the companies or entities directly affected by the event, and second, we need to precisely define the specific event period itself. So, for this particular example, let's consider the situation that arose during the fiscal years of 2022 and 2023. Throughout this period, a significant policy was implemented. A mandatory minimum tax of 15% was directly imposed upon major corporations and large-scale businesses. So, even if these large corporations attempted to avoid paying taxes in certain situations, they were still compelled to pay a minimum of 15% on their adjusted yearly income. Therefore, the firm being analyzed in this particular scenario would be a large established company. So if we examine our firm size description, you'll notice that what we consider big firms are those that score above, let's say, an 8. This essentially means we're identifying the largest 10% of all companies, those at the 90th percentile or higher, and classifying them as significant entities. These particular large firms will then be directly impacted by the new minimum tax rate, which is scheduled to be implemented either in 2022 or 2023. Alright, if you navigate to the dummy variable section, we can then proceed to build that out. So let me just select the appropriate size. First, we need to establish a clear threshold for our analysis, specifically choosing a value that is strictly greater than 8. We'll then assign a descriptive name to this newly defined variable, referring to it as the big firm's dummy. Following this, we will proceed to integrate this indicator into our model. So, in our data, we have nearly 6,961 firm year observations which take on the value of 1, meaning that they are considered to be big firms in these specific years, and a value of 0 otherwise. The final step in our process is simply to wenzorize the data in order to minimize the impact that outliers might have on our results. Therefore, I'm going to select every single one of the x and y variables and wenzorize them. Pause specifically at the 1% level, and after that is finished, we will go ahead and generate the final versions of them for the study. Alright, then we are all set to proceed. We'll simply scroll down to locate the advanced regression section, and then we'll select our y variable, which is specifically the growth in long-term debt, a key metric for us. And for our regressors, also known as the control variables, we will be including several key factors, specifically asset tangibility, the book-to-market ratio, return on asset, and finally, the company's overall size. Now we can proceed to test this important hypothesis by carefully running a statistical regression. This regression will specifically examine the impact of the particular event we are studying and also determine whether the firm in question has been treated. This analytical approach is fundamentally based on the core idea of what we call difference in difference. So to be more precise, let me elaborate on the modern DID methodology, which is indeed a difference in difference technique. This entire framework constitutes what is known as an even study. The adoption year in our analysis will represent the specific event year when the firms we're studying were impacted by the newly imposed tax rate. For the purpose of this example, we'll consider it to be the year 2023, ensuring that the policy has already come into full effect. Our next step involves selecting the specific firm that has received the treatment. It's essential to clearly define this treated firm before we can proceed with any analysis. Therefore, we must identify both the treated firm and its corresponding control firm. Treated firms, these are the ones that are affected by the event. Control firms, these are the ones that are not affected by the event. We need the control firm for this particular event, specifically to provide a counterfactual estimate of how the treated firm's Y variable, which in this instance is the growth in its long-term debt, would have evolved in the absence of the event. So this is the fundamental concept we're discussing here. We're using this purely for the sake of making a clear comparison. Therefore, in this particular scenario, our task is to identify and select the treated group, which by definition is represented by a dummy variable set to the value of 1. Therefore, any observation pertaining to a firm that possesses only a single value will be considered a large firm dummy variable. This particular data point will then serve as our primary treated observation for the analysis. After this initial step is completed, you will have the flexibility to select the appropriate event window. For instance, you might consider a period of 3 full years prior to the event and then 3 years following it. And here you have the option to base your calculation on data from the previous year, which is highly recommended. This is because recent news events might introduce some misleading or irrelevant information, potentially affecting the accuracy of your results. So, the actual reaction might have occurred one period earlier, or we could simply maintain the current timing. Therefore, let's proceed to compare the findings from our analysis. This means we should run the modern DID approach or simply the well-known difference in difference method. And now we're presenting the final results. So what exactly is this AT&T referring to? This particular metric should clearly indicate a difference. For instance, we can look at the difference in difference calculation. So if you look at this particular point, that will give you a good example. We calculate the difference in the growth of long-term debt for any specific year relative to the base year. In this specific context, the base year is considered to be either the event year itself or the year directly preceding it. And then, subsequently, we identify this same difference specifically for the treated firm. Now, even if you observe an increase in some metric, that doesn't automatically imply a direct causal relationship running from the specific event to these particular firms. Why is that the case? Because other control firms might also be simultaneously experiencing a comparable increase. Now, if you compare that difference with the difference observed in the control group, and if that result is positive, that indicates we have a significant effect. This whole idea of utilizing control firms is specifically to account for other influencing factors, various variables, and any time-varying variables that might also be present and could affect our findings in this particular setting. By incorporating these crucial control variables into our analysis, we are able to account for the specific conditions and characteristics of these settings. Consequently, the AT&T coefficient, as predicted by our hypothesis, should exhibit a clearly positive value, meaning that companies will rely on more debt when faced with higher tax burdens. Now, if we examine the data for AT&T, specifically looking at the period after or during the defined observation window, we can clearly observe a significant change. The results indicate that the outcome became positive, which means the estimated coefficient from our difference in difference regression model is indeed positive. This finding is directly reflected in the structure of the equation itself. Oh, the variable y in our model represents the growth rate of the company's long-term debt, and in this analysis, we have included firm fixed effects and also time or year fixed effects. We also controlled for these effects because it's possible that the treated firms might possess some unique characteristics or internal factors that could potentially explain the observed findings, rather than these findings being solely driven by the specific event, which is the increase in tax rates. So in essence, we can also account for and control for the individual firm's specific effects and any year-to-year or broader time period effects. This represents the primary coefficient in our analysis, indicating that we are effectively controlling for certain factors. Specifically, we could potentially apply or interact the treated group with the post-intervention period. That is, if it is positive, it means that being treated during the post-event period, we would expect to see a higher positive coefficient on the Y variable. And this is indeed the case because the coefficient is positive and it is statistically significant. We can also conduct this analysis, ensuring we control for all the relevant X variables. It's entirely possible that after the event, or even while it was unfolding, we observe substantial shifts in the underlying covariates. For instance, factors like the firm's size, its return on assets, or simply the key determinants of financial leverage. And that particular factor could potentially move in conjunction with the event itself. So we must carefully control for that to ensure our findings are truly robust and reliable. The initial figure did indeed decrease, however, its overall importance and impact remained quite significant. Consequently, we can clearly discern the observable effect in this particular context. Businesses substantially increased their long-term financial obligations. This phenomenon occurred directly as a result of the policy decision to implement a higher tax rate, specifically targeting larger corporate entities, and this specific conclusion is robustly supported by the data and analysis presented within this study. That's it for the difference in difference. Thank you very much for watching today.